Hello, it's Ryan here, CEO and head quant at happytrader.io. Wanted to do a quick video on win rate using TQQQ. So not only are we going to be doing a quick video on triple leverage NASDAQ, which is a triple leverage ETF, it's long only. There's also SQQQ, which is the short counterpart. We're going to run our long only back test against the triple leverage TQQQ. We did one other video about this, but there's a few other points that I want to make regarding this particular topic of triple leverage NASDAQ. And then also the main point of this entire video is going to be about why win rate does not matter. And what'll happen is a lot of times you'll get traders who might not be particularly equipped to be giving out strategy advice. Let's call it potential trading idea advice is what we will use for that terminology. And the reason for that is if we just pull up our strategy tester, I'll just illustrate this. We will go ahead and enable our long only strategy and we will set our parameters. We're going to use a deep back tester for TradingView, which is going to let us specify the entire year. We're going to plug in the 27th, and today is the 28th. We're just going to refresh it, make sure we have up-to-date data for the video. And you can see, a lot of people like to point out the win rate, which is the percent profitable. And you can see that the max drawdown is very low on this particular strategy. And this is using the 5-minute chart on TQQQ. Now, 167 trades year to date. We had a drawdown to like 975. So worst case scenario, you would have been margin called for like a couple dollars, or you would have got an email from your broker that said you had to deposit more money, right? So the point of this video is that the win rate does not matter. What does matter is really the position of having a larger set of winners that average out to a positive expectancy. So it doesn't matter if you're winning, let's say in this instance, less than 1/3 of the trades. You can see that the average amount that we're bringing in per trade over these 167 trades using our indicator up here, which is available at happytrader.io. It's private indicator, 47 a month, and that's what we offer, and that has our built-in strategies, which are uptrend, downtrend signals. Just wanted to kind of explain that in case this is the first video that you're coming across of us. By the way, if you're into trading and you want the straight talk on trading, futures, pairs, coins, anything out there, ETFs, indexes, futures options, selling delta, selling premium, selling theta, whatever you guys do, even debit options, definitely hit the subscribe, the like, and the bell. This is going to be a solid channel. We are a startup as of 2022, so every like and subscribe matters. But when you look at the strategy tester, you can clearly see that all we're doing is we're waiting for our uptrend signals. We're basically just buying happytrader.io for 47 a month. We're getting our link to install it. We're just essentially adding the alerts for the sentiment AI buy and sell. And then what our back tester is doing is taking those AI buys, which are the uptrend signals, and then it's taking one position long. It's starting with $1,000. It's utilizing 100% of our equity, and it's not adding any subsequent uptrends. Like if we get two uptrends in a row, it's not going to pyramid those orders, meaning it's not going to stack those orders. Now you have a natural built-in scalability and this is what's cool about instruments like TQQQ, when you have a longer term market drift, is that when you use something like the 5-minute chart, which is really what we're optimized for, is that shorter time frame trading across any type of ticker. You can still use longer time frames. You just can't necessarily do it as easily as going from uptrend to downtrend. Sometimes you're going to need to know, hey, we're halfway up this move. we're going to probably take profit here. This looks like a good idea. Now, just focusing back on the win rate, let's bring the indicator away. Well, we'll show the indicator. We're going to take it away and we're going to stretch out the strategy tester, and you can see the equity curve's fine. We've done 88%, 88.65. So on our 1,000, we've done 88%. The regular stock market does between like 7 and 11%, like I mentioned in pretty much every video that I make, and 167 trades. And this is just for year to date 2023. Now, if you were to, let's say, use, I don't know, $2,000, let's see kind of what happens there when we change it, and we're still using 100% of that equity. You can see we go up about a percent, things change a little bit, but you can see that scalability starts to kick in, right? But you still have kind of that same drawdown, and you still have kind of that same percent profitable, right? So you're probably thinking, well, what if I have like $10,000 and I want to use 100% of my equity in 2023? And what would that do? Let's look. You're going to have about a 90% win rate, slight fluctuation. You're going to have about the same drawdown. You're going to have a very similar looking equity curve. So the point is, you know, scalability of your capital that you're deploying out to a strategy is more of a constant than you may be aware of, right? So the key, therefore, is that having the positive expectancy in its own is what matters, and win rate does not solely determine expectancy, because a lot of strategies, what they'll do, and let me pull the chart back up, is you'll get folks out there not only just talking about this on YouTube and stuff like that, who may not, have the actual experience to back this up, but they might be selling 5 to 10 delta options, which carry a huge risk. When you're selling an option, that can wipe your account out completely. Now, I'm not saying selling options premium is bad. What I'm telling you is that it's definitely riskier. So what you're doing is, the market's hanging around in here. We're kind of in the trenches the way we're trading, where someone who's selling options might be selling in these ranges, right, outside of the action. So they're kind of more of a commander, where what we're doing is we're trading right inside of the market. So what that's going to do is, when you're in the market, if this makes sense, and I hope it does, and I don't like when people say, "Oh, does that make sense? Does that make sense?" But this is a really important concept, is that when you are trading closer to the money, your max loss and your win rate is going to tend to be less, because you're right in the chop. When you're outside of the market, you're going to have a much higher win rate, such as selling premium. But when you get that one day where that market goes, um, 3 times the expected move, you're going to get blown out on that 5 to 10%, especially if you're not an advanced trader. So, therefore, win rate, you can only protect these trades in certain ways, like rolling them out in time. And even that can get sketchy. So you really have to be careful. I'd say in this market, the risk is mostly on the put side. You wouldn't want something crazy to happen and to have a strangle on or something like that on portfolio margin, even at a further DTE like 60 or 90. To me, I just can't sleep well at night with that high win rate, because with that high win rate, there's no free lunch on Wall Street, as they like to say. And with that high win rate comes extreme amounts of risk if you don't hit that percent profitable target 5 to 10% of the time. So I do hope that that made some sense, and I'll go into selling options premium on another video. But the point is that the size of the winners relative to the losers is what's going to cause positive expectancy. And when you scale the amount of money that you are using in your account at 100% equity, and let's say you're scaling up into, like in this case, if we're starting with 100K, it's still roughly the same test with roughly the same graph. So the capital you're deploying, a lot of people think of the capital as, oh, the capital in, the capital out, that's the variable. Well, the variable really is going to be this, right here, this win rate. And what we can see is if we just switch everything back to a small account, an everyday person who's just trying to trade in the markets, let's say they want to use Happy Trader and they want to use uptrend and downtrend signals, well, you can actually go to the list of trades and you can see this illustrated. So you can see that you will lose a lot of trades, but you'll get these outsized winners. So like you'll get like, you know, that clump of trades right there. And then you can see more smaller losers. That one's kind of a big one, but you can see a huge string of them. But then look, 65 and 50. And then we start to see, let's go down a little further, 52. And let's go down. You have a string of losers. You have a 28, a 61, and a 31, 176, and you can see that the losers tend not to be this big. So what happens is instead of going through all the trades, you can just see that the average trade what won, the losers and aggregated against the winners, and you can see that you have your 0.44%. And again, this is about a probably roughly 8 times what the market would do, and that's just to illustrate here that the win rate's not important when your max drawdown is this low and you're able to come in here and trade an instrument like TQQQ just using uptrend and downtrend signals, and having your Illuma trend there as well. So that was really what I wanted to go into today. Is the scalability aspect is more of your capital, which is going to be more of a constant when you're looking at expectancy, but the win rate is going to be real tricky. Anytime you have a strategy that has an 85, a 90, a 95% win rate, that's generally going to involve selling options, where this particular strategy actually just uses $1,000 of capital. And if you think about kind of the implications of that, that's just to buy stock. If you were to buy even one call option, that will control roughly 50 shares at the money, and then deep in the money, it's almost synthetic 1-to-1, especially if you're buying options far out in the future at a very deep in the money price. So you can kind of um, do some math in your head of what that kind of adding leverage when you're confident in a strategy, compared to when you're using lagging indicators that may not tell you anything about what the market, and you're just looking at what the market's already done, and you can think what the market might do, but when you have something like our indicator, um, you'll be able to see kind of ahead of time what the market is more likely to do. And let's just shrink that down a little bit. But I wanted to go over win rate in today's video. You can see that you can 10x the market as per our back test for 2023 using TQQQ, which is a triple leveraged long ETF. Something you need to be aware of is there is volatility decay on these long ETFs. They're not designed to be held long term. They're designed more to be traded, but that's okay because happytrader.io, Sentiment AI with the Lumatrend is designed for short time frames, long time frames. It all depends on the instrument that you're trading. But go ahead, hit that like, subscribe button if you're looking for more back tests and more ideas and trading ideas and strategic things related to trading. I will be going over a lot of that pretty much each and every day. So this will help you definitely become a better trader. And if you do decide to take the plunge on happytrader.io, that's going to basically give you training wheels for the market. And you're not going to have to worry about RSI, MACD, or anything that's lagging. You're going to get some of these signals popping up, ahead of the time, giving you the heads up like, hey, we're in a buy signal. We might get an uptrend. So again, this is Ryan from happytrader.io. Have a safe day. Stay warm if it's cold where you're at. I know it is here in Georgia, and happy trading. Have a great day.